And housing's not the only sector feeling the pain from today's jobs report and the prospect of higher rates. My next guest says it's the biggest risk to markets. Without softer employment data, we're going to continue to move higher and equities will continue to struggle. Here with me now on set, Michael Kantrowitz is Chief Investment Strategist at Piper Sandler. Great to see you. Welcome.
Thanks for having me.
We have this sort of ominously ticking over our shoulders here. And look, 1.35% down, not a huge deal, but what do you think is the bigger story here?
Well, it's a rate. It's been rates. And ironically, if you look at market breadth, that peaked around middle of September when the 10-year bond yield bottomed out at 360. And as bond yields have crept higher, it's engulfed more and more parts of the market, beginning with rate sensitives, real estate stocks, and home builders. Then it got into small caps and value stocks. Remember, in December, breadth started becoming a focus.
Absolutely.
And now it's engulfed the entire market. And we thought 4.5 was kind of the line in the sand on the 10-year where we become more systemic. And now what you're seeing behaviorally from investors is people are extrapolating, talking about rate hikes. We're talking about the 10-year going to the 5% and 6%, and so on and so forth.
The crazy thing to me is to look and say, okay, we're at 476. The highest we've ever gotten this cycle was 5.04. So we're within 30 basis points right now. Now, that high was a high that I'm not sure if it came exactly before or after the Silicon Valley Bank problems, but high rates seemed to be a huge headwind the first time around.
Yeah.
Now, the second time around, I mean, you're right. There are a lot of parts of the market that aren't holding up, but it doesn't at all feel like the same level of seriousness that we saw a year and a half, 2 years ago.
Yeah, that was around September or October of 2023 where we got over to 5% of the 10-year. The big shock was in 2022 when rates were really low and there wasn't a lot of inflation risk pricing in the markets. Valuation was high, credit spreads were tight. You know, somewhat of a similar equity backdrop and risk backdrop that we came into this year. And so the risk, how I see it, is that as long as rates are going higher from what appears to be a systemic level, the equities are going to continue to struggle. I think essentially equities and bonds are the same thing right now.
Well, you make a good point that back in 2022, we went from 0 to 5% practically,
Yep.
and did so in a way that many claimed to be caught off sides. Now people are used to rates around where they are. So does it make that much of a difference if we go from maybe cutting twice this year to holding them steady or even hiking a little bit?
Well, it's not only interest rates, it's the dollar. The dollar has been more correlated to the 10-year than in any point in the last 40 years.
Wow.
And the dollar is at an all-time high today when you look at the trade-weighted broad dollar. So it's not that we have to get used to rates, it's the expectations where we're going to get all these rate cuts, and now we're paring all that back and now starting to talk about hikes. So it's sentiment, and that's why you're seeing equities move around, not because earnings have radically changed, but that sentiment has changed.
So what do you do? Because probably, I don't want to call it contrarian, but there's not a lot of people who come on this show and say, I'm sticking with the Mag 7. But if these dynamics that you're describing persist, it sounds like that's the only game in town.
Fundamentally, perhaps, but many of those stocks are very expensive too. So what we're seeing on a day like today is that the low quality, high beta, no profit stuff is getting hit, and a lot of expensive stocks are getting hit, in addition to the rate sensitives, of course. So in our outlook in 2025, we're actually, I would say, more constructive on the economy than we are on the stock market. Mm-hmm. And that's with the view that if things get a little better or stay good, rates are going to stay here or move higher. Of course, we have the wild cards of tariffs and who knows what else is to come. But our view is that PEs have fully priced out all of the macro risk that really showed up in 2022 as we came into the year. And now we're pricing that risk back in, and that shows up in the form of lower PEs.
You're staying away from small caps then?
Yeah, small caps don't have earnings. And
especially if rates stay up where they are now.
The only reason small caps have gone up in the last 2 years is because their PEs went from 11, I'm using the S&P 600, from 11 to 17 by the end of basically around the election. All of it has been multiple expansion on the view that rates are going to come down. Eventually, we're going to get better growth. Rates staying higher for longer just pushes out that likelihood of a pickup in small cap earnings further out.
I know we have to leave it there, but then in a nutshell, I mean, do you recommend? I know what you said about like high valuation stocks are in trouble, but is it the Mag 7 you stick with, or is it more of the high quality and sort of those kinds of names?
So real quick, we think we're going to see some better improvement in manufacturing activity, which I think we're starting to see already. The ISM index manufacturing activity, I think, is set to improve more. It's already started. That should give us better earnings breadth. So I think, we've been really leaning into growth for the last 2 years. We're more looking for quality value versus quality growth this year.
You're willing to say the value name. That's been a dangerous bet in recent
quality
memory.
value.
Quality value, I know for sure.